Okay, so we've got this question from the ACCN paper in June 2017. It's quite an interesting one because it's marginal costing, but it's involving a service business. So all the examples we've seen recently have involved manufacturing businesses, but this one is offering services. So we've got PR Support Limited. It's a service business providing administrative support to business. Remember, a service business is one that provides a service rather than making goods. The company operates three separate departments: payroll, market research, and financial services. So these are three areas that the company is offering services in. So they're offering payroll services, market research services, and financial services. The directors are currently preparing budgets for the year ending 30th of April 2018. Now, remember, this was set in 2017, so this would have been in the future at the time. Now, we've got some fixed overheads. The company's fixed overheads include the salaries of its employees. They employ 4 staff in each department, a total of 12 employees. So the 3 departments each employ 4 staff. Each employee is paid a salary of £15 per hour for working a total of 40 hours a week for 48 weeks per annum. Any overtime required is paid at a premium of 50%. Okay, so let's work out while we're going along here the basic salary. So we've got 12 staff, each paid £15 an hour, 40 hours a week, 48 weeks per annum. So the total cost there is 345,600. Okay, and in terms of hours, so the hours available in each department are based on 4 staff working 40 hours a week for 48 weeks of the year. So 7,680 in each department. Okay, the company's other fixed overheads of £75,000 per annum are split equally between the 3 departments. So that's £25,000 for each department. In addition, each department incurs £7 an hour variable overhead costs. Okay. PR Support Limited charges clients £30 per hour for the services it supplies. The directors require a profit of £30,000 from each department, not overall, from each department in the year ending 30th of April 2018. The Market Research Department is budgeted to make a profit of £34,000. Financial Services Department is budgeted to make a profit of £36,000 in this period. Due to inefficiencies and lack of available work, the Payroll Department is budgeted to work at 95% capacity. However, the other 2 departments are budgeted to work at 100% capacity. Okay, so there isn't enough work to keep the payroll staff fully occupied at the moment. They're 5% under capacity. So the first thing it's asking us to do, this is broken down into a sequence of tasks, but the first thing is to calculate the number of chargeable hours required in the payroll department to produce a profit of £30,000 for the year ending 30th of April 2018. So this is a target profit. So the way we work out the number of hours needed to achieve the target profit is to take the fixed costs plus the target profit and divide that by the contribution per, in this case, hour. We're not doing units, it's the contribution per hour. So the contribution per hour, contribution is £30. That's the selling price. £30 an hour is what they charge the clients. And then we had £7 worth of variable overheads. So it's £23 per hour. Okay, so the fixed costs we worked out up here was a total of 345,600, but that was for 3 departments. If we divide that by 3, that gives us 115,200. So the fixed costs are 115,200 plus the £25,000 worth of overheads. So we'll add that to it. And then if we add the target profit, 30,000, and then divide all of that by the contribution per hour, which is 23. So we've got 115,200, 25,000, we've got 30,000. So the total costs, just write that there, 170,200 divided by 23 means that they need 7,400 hours, okay, to achieve that target profit. So they need to charge out 7,400 hours. Okay, so that's the first part done. Okay, so if we move on to part B, then it's asking us to prepare a budgeted marginal costing statement or marginal cost statement for the payroll department to show the profit for the year ending 30th of April 2018. Okay, so remember, for a marginal costing statement, we need to show clearly the contribution. So let's start with the sales revenue. Okay, so we're charging them £30 an hour. We've got 7,680 hours available, but remember, they're only working at 95% capacity. So if we do 95% of that, 7,680 times 95% means that they're working for 7,296 hours. Okay, so the sales revenue, £30 times 7,296 is 218,880. Okay, remember that the variable costs were £7 an hour, so it's going to be £7 for every hour times the same 7,296 hours. So 7 lots of 7,296 is not 7,303. I don't know what I hit there. Is 51,072. So if we take that away, that's going to give us the contribution, which is 218,880, 167,808. Okay, so that's the contribution. Then we've got to take away the fixed costs. Now, we already worked the fixed costs out down here. We had 115,200 for the staff, and then we had 25,000. Oh, excuse me, I have hay fever. So the fixed costs are 140,200. If we take that away, then that gives us the profit for the year. Budgeted profit 167,808 minus that is 27,608. So there is a slight shortfall on the budgeted profit figure. Okay, so that's part B done. Another 4 marks sorted out. Then we've got some additional information. Let's have a look here. So it says that the directors of PR Support Limited feel that the performance of the payroll department should be improved. They're currently reviewing 2 exclusive opportunities that have arisen. So option 1 is an overseas company has offered to process all the work of the payroll department for the year ending 30th of April 2018 and beyond. The price that has been quoted to the directors is £21 per chargeable hour. Okay, so they'll do all the work. The payroll department would not be required and would be closed down. So that would obviously lead to redundancies unless we can redeploy the staff. Okay. The second option is that the directors have the opportunity to take over all the clients of a competitor. This will result in an additional 4,200 chargeable hours per annum in the payroll department. This extra business would require the department to take on a further 2 full-time employees and would involve the department working at over 100% capacity. Okay, so the directors are aware that in order to keep their existing experienced staff and recruit qualified new staff, the company would have to increase the fixed salary in the department from £15 an hour to £18 an hour. Okay, so the first thing we're asked to do is to calculate the total contribution for the year ending 30th of April 2018 from the contract if the directors decide to proceed with option 1. Okay, so it says to tick 1 box only. And they've given us some space for working out. Now, remember that we were charging them, I think it was £30 an hour. So £30 an hour minus the £21 an hour. And then times the, how many hours were we working? Not that one, wrong page. Times the 7,296 hours. So we're going to earn £9 an hour contribution times 7,296 is 65,664. Let's just write that on there for completeness in case we need to come back to that. Okay, so that was pretty easy. I suspect there'll be more to do with this additional information in just a second. For part 4D, we've been asked to calculate the total budgeted wages of the payroll department for the year ending 30th of April 2018 if the directors decide to proceed with option 2. So let's just remind ourselves what option 2 was all about. Option 2 was taking over all the work from a competitor and having an extra 4,200 chargeable hours and everybody working at 100% capacity. So the way to tackle this one is to work out how many hours we need in total. So current hours, we have got, let's have a look, we've got 4 staff working 40 hours and they're working 48 weeks. So that gives us 7,680. We've got the additional hours, which was 4,200. So that means we've got 7,680 and 4,200. We've got 11,880 hours we need. Okay, that's needed. And hours available at the moment. So if we have 6 staff working 40 hours a week and working for 48 weeks, that means we'll have 6 times 40 times 48 is 11,520. So there's a shortfall which we're going to need to fill with overtime hours. So the difference between 11,880 and 11,520 is 360 hours. We've not been left a lot of room here. So the cost is going to be 11,520 hours, and we are paying them, I think it was £18 an hour we've put that up to. So 11,520 times 18 is 207,360 plus overtime, which was at time and a half. It's 50% overtime premium, so that's going to go up from 18 plus 50% to 27. So 360 hours times £27, 360 times 27 is 9,720. So the total cost for labour is the sum of those two, which is 217,080. Okay, so that's what the wages bill is going to be. Now, if we remember that this is going to be a fixed cost, the overtime is going to be a variable cost. If we don't do the extra work, we're not going to pay that cost. So when we come to work out the marginal cost statement for the payroll department using option 2 in part 4E, we need to do the sales. We're going to base that still at £30 an hour, but we're doing the full number of hours, the 11,880 hours. So our sales figure is going to be 356,400. We've still got the variable costs at £7 an hour times 1180, which is going to be 83,160. And then we've got the overtime. I'm going to include that. It doesn't actually give us any direction in the question. I have looked at it. Perhaps you can tell me if I've missed something. But I'm going to include that, the overtime premium, as a variable cost. Some businesses will include it as a fixed cost. Others will include it as a variable. I'm just going to stick it in here in the absence of any other information, on the presumption that if we don't do the extra work, we won't be paying those costs. So the contribution now is 263,520. Then we've got to take off the fixed costs. So the fixed costs, we've got the wages, the 207,360 that we've got to pay regardless of how many hours. That's for the 6 members of staff. And that 25,000, if you remember, for the payroll department. So the total of the fixed cost is going to be 232,360, which means that the profit for the year will be the difference between those two, which is 31,160. So that's another 4 marks. Okay, I think we are slowly getting there. Just part F to look at now. Okay, so for part F, it's asked us to advise the directors which option they should choose. And all I've got here is the mark scheme. I thought I'd just run through it quickly, just to highlight a few points. So it says there, under financial issues, that option 1 will produce the greater contribution or profit than option 2. Now, if you look at option 2, we were bringing in a profit overall of 31,160. If we go with option 1, remember the fixed costs are likely to go right the way down. So we've got 65,664 was the contribution if we subcontract out all of the work. But don't forget that we're likely to retain that £25,000 in fixed costs. So 65,664 minus 25,000 gives us a contribution and an overall profit of 40,664, which is higher than the profit for option 2. But it would involve closing down the payroll department. That's going to have potential redundancy payments because we're going to keep the fixed cost. That 25,000 I just spoke about there is going to be retained. So they'll have to pay that. But it should result in overall company profits in the long term at least. One issue, though, remember that this was an overseas company, so we might have a problem with exchange rate changes. That could affect the amount we charge. We could see an increase on the £21. And there's also going to be some potential training costs for the overseas staff. It's not clear who might be paying for those. Option 2 does achieve the director's target profit after covering all the fixed costs, so that's quite good. So this was just keeping it in-house and taking on the extra couple of staff. That's going to give us a profit of 31,160. So when you're writing about these things, you ought to be referring to the figures that you've calculated, because I can see that this sort of question now wouldn't be 12 marks. It would be in a smaller fashion. It would be probably one of the 6-mark questions attached to a 14-mark computational one in section B, or could potentially be sort of plumped up to be a 25-mark essay question. Who knows? Where did we get to? So staff in the market research and financial services department might start to demand an increased salary if they find out that the other department have gone up to £18 an hour. They may ask for a raise, so that would eat into profit. We're going to have training and recruitment costs for the extra 2 staff, so there might be some extra costs there. Non-financial issues, main one's going to be quality really. The subcontractor's standard of work may not meet the in-house standard, and we may end up losing clients because of that. Could be confidentiality issues, communication issues because they're overseas, lack of direct supervision, again back to the quality control issues there. Will the supplier business continue to operate in the future? Because if we've subcontracted it out, we're going to be very dependent on that subcontractor company keeping trading. If they don't, then we've got a problem. It may be that if people are unhappy with the payroll, that we end up losing clients, from all 3 departments. We may have clients that use market research and financial services as well. So if they're dissatisfied with one of the departments, they may leave totally. And then we've got strict deadlines, obviously, for payroll processing. If we don't meet those strict deadlines, then that could be an issue. And if we do make staff redundant from payroll, there could be some concerns over job security in other departments as well. Okay, and it may affect our brand reputation if they find out that the work is outsourced rather than done in-house. Option 2, we're increasing the fixed salary of the payroll department. That may cause resentment and demotivation in the other 2 departments. So this is back to the £18 an hour. Will the payroll staff be willing to work the necessary overtime hours? So we worked out that we'd need an extra, I think it was 360 hours. So are they going to be willing to do that? Will staff in the other departments be resentful at the availability of overtime payments in the payroll department? Are they going to be able to recruit 2 suitable staff to take those jobs? And will the quality suffer as a result of the workforce working at more than 100% capacity? So people are maybe tired, maybe making more mistakes. So you've got to give some advice now. You have to say either clearly option 1 or option 2, and then justify it. So like we would do in those 25-mark essays, come down one way or the other. Don't sit on the fence with this one. This is one that needs a clear decision. So hopefully that's given you an idea. As I said, it's quite an unusual question. We've not really seen anything like it since, certainly not in the new specification. So this was marginal costing, using marginal costing to make decisions, not really make or buy, but whether we should continue to produce the services or buy them in. So it is a kind of make or buy decision, but just, as I said, quite unusual. So hopefully that's given you an idea of just another style of question that might crop up in paper 2. Thanks very much for watching. Don't forget to like and subscribe if you've enjoyed the video.